Good morning, cost accounting students. In this video, we're going to look at the basic principles behind budgeting, variable budgeting, and it will lead us to the basic principles that will help us do standard costing, which is the next section we're going to get into. So we're going to go ahead and look at our notes. And specifically, we're looking at the example at the top of page 14. This may have been partially worked for you, but I'm going to rework it again. Just the background behind this section. We already said that the management part of cost accounting is about planning, leading, controlling, decision making. And specifically here, we're looking at planning, and then standard costing will be looking at the controlling. So what do we mean by a plan? Well, a financial plan is a budget. We all hopefully have budgets in our own personal lives. We draw up a budget so we know how much resources we're going to need in a particular period. We can look at the cash flows coming in, the projected cash flows going out. We can identify any potential shortfalls, and we can plan on how we're going to address those. Obviously, a budget in itself means nothing if we don't actually then go and compare our actual results against that budget and see where we have gone wrong. Now, that might work perfectly fine for you and I in our personal lives, but when it comes to a business, particularly a manufacturing entity, their original budget, which we call the master budget, would have been based on a projected level of units sold and produced. We'll keep those two the same for this conversation. That original budget is known as the master budget. Now, when we get to the actual period, the level of production and sales might differ significantly from that master budget amount. And it's of little value comparing actual results against a master budget if they're based on different levels of activity. So our first step is to take that original master budget and to revise it or flex it or vary it so that it matches our actual level of activity. So in this example in our notes, we had a master budget based on 50 units. Now it so happens that we sold 60 units. So we need a new budget to be able to compare against the actual results, which are shown below. And this is the same information we'll use for our first advanced standard costing problem. So let's go and take our original master budget and get some basic variable and fixed costs out of it. And if we take the costs and revenue and we divide it by the number of units, we'll see that the selling price per unit is $10, the materials is $2, the labor is $1, variable manufacturing overheads is $1.50. Obviously, fixed is fixed. Our admin and selling cost, fixed is fixed, but the variable selling cost works out to 50 cents a unit. So we could probably actually go and do this calculation without redrafting the whole income statement to see what our profit should be at a level of 60 units. Let's just show you what we would do there. We would go and take, remember, selling price, $10 minus our variable costs, which is 2 plus 1 plus 1.5 plus 0.5. So that's a total of 10 minus, what's that for? 5. So it's $5 times our new units, which is 60, minus our fixed costs, and our fixed cost is the 175. The 75, which I get from my fixed selling costs plus my fixed production costs of 100. So we have $5 times 60. Times 60 gives us 300 minus 175, and that means that our profit should be equal to 125. Let's see that we get that number. Okay, so units, 60 units times $10, that's going to give us 600. Material, 60 units times $2, that's 120. Labor, 60 times 1 is going to be 60. variable, $1.50 times 60 is going to give us 90. And then our fixed costs obviously stay the same, 100. So if we add all those up together, 120 plus 60 plus 90 plus 100, 60 plus 90 plus 100, that gives us a total of 370, which means that our gross profit is going to be 230. What is the admin and selling cost going to be? Well, our fixed admin don't change, that's 75, but our variable admin for 60 units times 50 cents is going to be 30. So this is 105. 105 minus 230 gives us 125. And what did we expect? 125. Now what we can do is go and take this information that we have now, we can go and then compare it against our budget to identify these differences. So I'm just typing these in. We have the materials, labor, variable overheads, fixed manufacturing, fixed selling, and variable selling is 30. And our profit is 125. Okay, so now if we go and take our actual and subtract our flexible, which actually turns out to be our standard, we'll get 120 here. And just for no interest sakes, we're happy about getting that extra money. There appears to be no difference in materials. We have an additional $48 of expenses, which obviously we see as unfavorable. We have an additional $54 here, which seems unfavorable. We have $10 more for our fixed manufacturing costs, which is unfavorable. We have $5 more for our fixed selling costs, which again, we don't like more, spending more money, so it's unfavorable. And then finally, we have $6 less on our variable selling, which is favorable. And if we add all these up together, they should give us the net difference between the two profits, which is a total of 9 favorable. So that ends our little example on the idea of a flexible budget. What is it? We take the original information from master budget, we identify fixed and variable costs, and then we project what our budget would look like if we knew what our actual level activity or production or sales or production actually ends up being. Thank you.